This is the Human Action Podcast with your hosts, Jeff Deist and Dr. Bob Murphy.
Ladies and gentlemen, welcome back once again. It's the Human Action Podcast. I'm your host, Jeff Deist. Bob Murphy's not with us this week, but we're in studio with a good friend of mine, Allen Mendenhall, who lives here in Auburn. He is one of the deans at the Troy University School of Business, which is right down the road from us. And so, Allen, for good or bad, apparently you've taken upon yourself to become an expert in and also an outspoken opponent of this ESG/DEI movement, which is taking place not just at the governmental level, but very much in the investment banking level. So ESG, of course, for people watching, is environmental, social, and governance, meaning board governance within companies. DEI, diversity, equity, inclusion. I noticed they don't do DIE. It's DEI, and so this is something which is happening in the United States, and I think, as we so often find, the right, for lack of a better term, is on its heels defending against this, and the left is pushing forward. So how did you get involved?
Well, we launched a new program in the Sorrell College of Business called the Free Enterprise Scholars Program, which was motivated by Vivek Ramaswamy's book, Woke, Inc., and we initially conceived of the project as pushing back against the wokeification of corporate America. But it turns out what that really involves is this ESG movement. And ESG is a very difficult subject to discuss in a lot of ways because there are about 1,000 different things going on under the E, and 1,000 different things going on under the S, and 1,000 different things going on under the G. And to really speak competently about it, you have to know a lot about mutual funds, exchange-traded funds, or ETFs. You have to know about financial services, stocks, bonds, proxy advisors, virtually all aspects of investment, whether it's state pension monies or sovereign wealth funds. Mm-hmm. And you can't be an expert in all these things. No one can. And interestingly enough, it's all these different sectors and government actors and high net worth individuals and institutions operating in concert to mainstream ESG. And this is by design. I mentioned to you in private conversation once about the Who Cares Wins conference, which was hosted by the United Nations and the government of Switzerland, among others, in 2004. And the target goal of that conference was to mainstream ESG. And so they invited...
This is 2004.
This is 2004. So they invited high-level executives at places like Goldman Sachs, but also people from central banks, also sovereign wealth funds, regulators, to figure out ways that asset management firms and other institutional investors could mainstream ESG. So there's been a roadmap. A report was issued after that conference, and it developed sort of a roadmap, which has been followed over the years. It was all out there in the open for people to see, but people weren't paying attention. Now, it didn't gain traction at first. I think a lot of financial institutions and banks and investors were hesitant at first. But we had the TARP bank bailouts of 2008, and people got really mad at the banking industry, and rightly so. And then the banking industry, I think, saw ESG as an opportunity for good PR. They could say, you know what, everybody hates us, but if we embrace this sort of, we're going to change the world stuff, maybe we won't look so much like the bad guys. Right now, everyone's saying, oh, why has nobody been thrown in jail? Why has no one been prosecuted? Why did all these banks get bailed out and people got away with it? Well, maybe we can conceal all of our bad acts, all of our mischief, by embracing this new ESG movement. So there is, to no small degree, a layer of ESG that is just purely PR on behalf of all these financial institutions. But obviously, they're the true believers as well. And like I said, it's a complicated thing. Most simplistically put, though, I think you can think of ESG in two ways. One is on sort of the micro level. It's just the framework that a private company may use in order to institute those environmental, social, and government measures. But in a broader perspective, we're talking about all those things, the central banks, governments, sovereign wealth funds, regulators, institutional investors, all those things are using non-financial standards and factors to allocate capital and assess risk. And that's what we're talking about at the macro level, what ESG is. And at that macro level, you have some of the most powerful players in the world operating in concert with governments to try to exert pressure on the private industry in all segments and to basically make ESG completely mandatory through government coercion and compulsion. Otherwise, if it were just purely private competition, ESG could never work. It would never win out in competition. So from the beginning, everyone has known we have to operationalize this, institutionalize this through government functions, which is why we have the executive order by Joe Biden in May 2021 that basically said, figure out how ESG can be systematized through every single federal agency. And then we're now seeing it with the Department of Labor and the Securities and Exchange Commission most prominently in sort of recent media.
Well, there's the Lulbert argument, which says, well, these are private banks, these are private funds, these are private investors, these are private companies, and if people have interests in environmental issues or social issues or more social equity or justice in the governance or the makeup of management, the makeup of boards, then they have every right to invest in that, which is true. But as you're pointing out, there's now this unholy nexus between government actions, central bank actions, and ostensibly the private financial markets. So that's one thing. Number two is I think we have to say that apart from the billionaires and the bankers who are just self-interested in all of this, and they're just trying to put a nice veneer over their money-making, there are also true believers. I mean, there are, at that sort of nasty progressive level, there are people who would say, hey, look, if the return is 10% less, we don't care, that's fine. Like, that's one thing the left does better than the right. Like, they will literally put their money where their mouth is in the sense that they care more about their social programs oftentimes than maybe, at least at that middle level, their narrow economic interests. So, I mean, that's something I think we have to consider. But tell us a little bit more about how, what's the relationship between government and big, let's say, institutional investors? In other words, they didn't just all decide this on their own. There's a relationship here.
Well, I'll say this, the bigger the institution, private, whether it's a private corporation or whether we're talking about big banks or whether we're talking about BlackRock, State Street, Vanguard, those big asset management firms, they love the idea of instituting ESG through government regulation because the bigger they are, the more capable they are of absorbing all those regulatory costs, whereas sort of low-level entrepreneurial, startup companies and small businesses can't afford to comply with ESG regulations. Now, the SEC regulations, of course, apply to just publicly traded companies, but it's coming for everybody. It's not going to just stop with publicly traded companies. And it will be interesting, by the way, just as an aside, to see how many publicly traded companies decide they need to go private to avoid these regulatory burdens that are going to be coming. But the more powerful the company, the more it can use these government regulations to squeeze out competition. So these big institutions love the idea of adding new regulations and growing even more dominant in a market in which they're already dominating, in no small part because of government. Now, ESG ratings agencies are another field which has become an astonishingly wealthy industry, and ESG ratings tend to be all over the place. It's a common criticism that these ESG ratings agencies have not developed any uniform standards or metrics for weighting companies. And there's an argument that say, McDonald's and Burger King are getting outstanding ESG ratings with companies, but isn't fast food pretty much bad for humanity in general? Isn't it doing bad things? And then we get into what you were just talking about with the true believers, companies that aren't true believers, that are either woke washing or greenwashing, which is essentially pretending to care about these things, but not really caring about them, reporting whatever they have to report to these private ratings agencies in order to get a good rating. And they're either lying or they're fudging numbers or they're, acting sketchily. Well, these private ratings agencies aren't government. They can't subpoena people. They don't have those kind of government powers to force these people to, compel them to turn over these different forms or inside information. So there's a call for from people on the left who don't like the woke washing and don't like the greenwashing, and they're the ones saying, "Look, we need more government regulations because we can't get any sort of uniformity through these private ratings agencies," and that's a problematic problematic area. I think that this is all fairly new stuff, even if it has been developing since 2004. And if we gave it enough time, these private ratings agencies would be able to come up with something that is more uniform. But it's like one CEO of one of these ratings agencies said, "Look, if we don't do this, then government is going to capture this, and there will be no private ESG." So it's not that there's no place for corporations to take into account social goals or environmental factors, but ESG, as it's being instituted with this corporate government nexus, is highly problematic. And by the way, I want to say a little bit about how institutional investors are pushing corporations to the left, because the way it's being done violates a lot of longstanding law in the United States. We've always held this view of shareholder primacy, and that the purpose of corporations is to maximize profits for shareholders. And there's the Business Roundtable in 2019 sort of redefine the purpose of the corporation to say we're going to base it on this stakeholder model. And stakeholders can be employees, they can be customers, they can be basically anybody when you think about it. Broader society writ large. And that's convenient for some CEOs because they can say, well, if our goal is not to maximize profits for shareholders, and our goal is basically to help shareholders, then we don't actually have to make profits to be successful.
Yeah, we had a bad quarter, but we hired a bunch of women.
Yeah, we did all these things. We diversified our board of directors. We did all these things. So we actually fulfilled our purpose as a corporation. So we've been successful, even if we didn't maximize our profits for shareholders. But what these institutional investors tend to do that's very problematic is this breach of fiduciary duty. And in the media, we hear about all the time breach of fiduciary duty, for example, of an asset management firm, a BlackRock, a State Street, or a Vanguard, which is investing, for example, state pension money and putting it into underperforming ESG funds rather than funds that will yield more returns. So its standards for investment are non-financial. They're more political. And a lot of state employees have no idea that their money is going to support political causes with which they disagree. And that's the big obvious fiduciary duty. But what people don't talk about so much is these institutional investors, they've diversified their portfolios and their investments. And so what they like to do is buy a massive amount of shares in publicly traded corporations and deliberately push those corporations to the left. This is very popular among hedge funds in particular, not necessarily those asset management firms, but hedge funds. There are a ton of institutional investors that are hedge funds that are designed purely to politicize companies, and we saw this happening with Newsmax being removed from DirecTV a few weeks ago. But in this process, let's say you are one of these institutional investors and you decide that you're going to target Burger King over, you're going to buy a bunch of stocks or buy a bunch of shares in Burger King, but you also, also are invested in McDonald's, or it could be Chevron and Exxon or whatever. I'm just using companies that everyone knows, but now you're starting to push the policies and programs of this one corporation in this one direction, and if you're not doing it over here with the competitor, then you've got a stake in both companies, and you're hurting one financially while not hurting the other. And these are also other duties that shareholders have. And people don't talk about that element of fiduciary duty so much as they talk about the more obvious one, which is, okay, people are investing beneficiaries' money in ways that they don't consent to and don't even know about. And these beneficiaries are not getting the returns they would have gotten had the investments been in more solid investments. But just big picture, all this ESG movement, and the reason it's being pushed is because if everybody can get on board with ESG, then these investments aren't so bad,
relative to each other.
Relative to each other. If ESG can gradually squeeze out entire industries in, for example, oil, gas, nuclear power, tobacco, firearms, all these kinds of things that are the politically disfavored industries, if we can remove those from the market altogether and just start having a playing field of ESG-friendly industries, then ESG starts to look better. But we need massive coordination between big private investors, big private companies, government banks, government pension fund managers, corporate pension fund managers. It takes a lot more than a village. In fact, it takes a lot of people that have to get buy-in. And what we've seen over the last few decades is just a concerted, systemic effort to get that buy-in, and it certainly worked in Europe. And in the United States, it would have worked if people hadn't caught on. Within just basically the last couple of years, people are starting to catch on to this stuff. But the question is it too far gone to push back?
Well, it raises the whole question of what's an owner. If we think of Wall Street, we think of public capital markets. We think of investment banks. We think of venture capital, private equity. We think these are generally very wealthy people. These are politically and financially sophisticated, savvy people. They are generally left progressive in worldview. And so they are the investors. But down beneath them are little people, like little old ladies who happen to have worked for, let's say, the state of Alabama all their life. And so they have a retirement account with the state of Alabama pension fund. And that pension fund may well be invested in being controlled by someone at State Street or BlackRock or Vanguard. I have some Vanguard mutual funds. I mean, I'm a little tiny nothing sliver. But nonetheless, people, I don't agree with ESG goals, which Vanguard managers may well believe in deeply. So there's a disconnect. Who's the owner? If I own a share of a Vanguard index fund that owns X, Y, and Z company, my influence or degree of ownership is so incredibly attenuated. So that's a real problem. But I think something you mentioned earlier is the more fundamental problem, and this is why we have to break up. We can't live with these psychopaths any longer, because there's when you talked about stakeholder theory, the idea that it's something other than just maximization of profits for the benefit of shareholders as a company's raison d'etre, you cannot reconcile that with stakeholder theory. In other words, profits are socially beneficial, which is certainly the view of people in our audiences, or they're not. And I don't think those two worldviews are reconcilable any longer. I mean, I think it's a fundamental problem with worldview.
I think that's exactly right. I mean, the entire stakeholder model is predicated on the belief that businesses are bad and businesses don't do good things, and that profit maximization is inherently evil, and that the only way businesses can improve the greater society, can make the world a better place, is if they do something besides making profits. And what's interesting in this whole notion is that it's developed by some of the wealthiest people in the world, and a lot of it could be to play all the leftist activists and to get their buy-in, and meanwhile they don't really understand that, because they're not sophisticated in financial markets and investments and all these banking regulations and et cetera, et cetera. And they don't know that they're getting played. The left's basically selling out. The left used to be all about class. We're going to be helping the poor. We're going to be helping the marginalized. Well, what they're actually doing in this process is making not all billionaires, but probably more billionaires on the left than there are on the right. But they're making these billionaires get even more powerful, even wealthier. They're concentrating power in fewer and fewer hands. They are centralizing government. They are removing agency from people, and they're disproportionately impacting developing economies. I have friends in Guatemala who talk about ESG, and they say, well, look, if we start globalizing some of these regulations, we're going to be in a tough place. We can't afford to buy Teslas down here to comply with all. We're all going to have to walk to work, and we're already poor. How are we supposed to catch up when all of this ESG stuff is concentrating power at the top and making it really difficult, not just for emerging companies and entrepreneurs, but for emerging economies in the developing world to catch up? It is basically systematizing control over those types of regions that don't have the same political agency in the global stage.
Well, I think this is a challenge to us. In other words, if we think capital markets operating as they should are noble, they serve a noble function, which is to allocate capital to its best and highest uses. And we determine that by looking at a profit and loss statement. It's what you're doing is working or it's not. And we attempt to reallocate capital through public markets and also through private markets. And you mentioned earlier the SEC. Believe me, the SEC is very interested in regulating private companies as well. They're looking at Bitcoin and other cryptos very seriously. And there is legislation and movement within the SEC. When you think of Cargill or Koch Industries, some of these big private companies, they say there's so much money in these that they need to provide a greater level of transparency than they do. So there's, it's not like the SEC doesn't have an appetite. I would love to see formerly public companies go private. I think that's been salutary for Twitter. That's something I can wholeheartedly embrace. But the problem for people like us, again, with capital markets is that, Murray Rothbard is said to have asked Mises, how do you determine a socialist economy from a capitalist economy? What's the dividing line? And Mises is purported to have answered, well, if it has a functioning stock market. Okay, well, we have a functioning stock market. These are private companies. That's true. But at some point, does Mises's definition still work? Are we still a capitalist economy when things are this incredibly cronyist? And then, or should we consider the more Rothbardian conception where he says, look, every regulation is a de facto diminution in ownership. Ownership is control. Ownership is sort of a bundle of rights. And when the government comes along and says you have to pay a certain wage or you can't work more than 40 hours or something like this, that the government becomes your partner in effect. And so you have semi-socialism. You have semi-government control over the means of production. And so how should we be thinking about capital markets at this point? I mean, are they too far gone? I mean, are we living in a post-capitalist America when you throw ESG in the mix?
Possibly. I don't know. Now, what I'll say is that when Mises was writing about stock markets, the playing field was very different. I mean, in the 1920s, before the Great Depression, this is sort of when, the New York Stock Exchange had been around, but this is really about the first time coming out of the Great Depression, the first time when we start seeing investments in stock markets being something common among households and individual investors. This is something that is becoming a widespread practice, really for the first time. And we're talking no notion of what there were no mutual funds. If you wanted to diversify in the market, you had to go buy stocks in like everything in the market. That's how you diversify. You couldn't just buy a fund that that pooled across industries or whatever. And there certainly weren't exchange traded funds that would track an index or something like that. And there weren't 401ks and all those types of things. So in some ways, we are in just sort of a new world where these investments are different. We have a lot of different stock markets to choose from, and now we have ESG to deal with, and it's sort of interpenetrated by government regulations and with government actions, and I don't think we really have a clear notion of what we're headed towards. I don't think people know, because the world is so globalized now that there's an ability to coordinate and communicate in ways that just weren't possible in Mises's era. And so just the way investments and securities and everything else are done is just so different that it's hard to put a name on it, whether it's a threat to capitalism. I mean, that could very well be the case.
Yeah, you wonder what shareholder power is in the face of consolidation of investment. It's very, very tough for a person to have any influence over certainly a publicly traded company, unless you were rich enough, like a Warren Buffett, to buy a significant number of shares and earn yourself a board seat in the process, right? I mean, you could imagine unwoke or anti-woke people on the right who are very wealthy doing something like that and attempting to wrest control away from management. But, apart from this disconnect between, a low-level investor like myself, the intermediaries of the institutional investors, and then the actual, let's say, publicly traded company, but there's also an intermediary known as management. In other words, managers are probably less accountable to shareholders than they've ever been, right? In other words, there are true believers operating. We've certainly seen this in tech companies at the managerial level. We're having hearings in Congress this week on all these Twitter execs pulled in to be roasted by the conservatives. So the idea that shareholders are the boss is also imperiled by management who might not be very concerned with what shareholders think about ESG.
Yeah, I think with most companies that's the case, and the exception would be these companies that have the activist investors who go in with the purpose of engaging corporate boards, engaging CEOs and other high-level managers. And there was this notion after the bank bailouts and after the financial crisis of 2008 that part of the reason this happened was because you had shareholders who were sort of asleep at the wheel. They were too passive. They weren't engaged on a day-to-day level. So one sort of verb you hear a lot is we need shareholders who are more engaged. And that's what these institutional investors do, is they go in and they engage boards of directors and allegedly mitigate risk. But in so doing, they've sort of redefined the word risk so that risk is no longer purely financial risk, but risk of the effects of global warming on business down in the future. And when you use a term like global warming, it's amorphous enough that 5 years down the road, if someone says, well, hey, look, this risk didn't pan out, you say, well, of course it's in the process. But because you can't point to any very specific, concrete phenomenon out there in the world, you're always able to sort of say, yeah, we are mitigating risk, because you've defined risk as something that is so vague that it means nothing. The other thing that you see with these institutional investors and risk is that they say, well, one of the risks that we're trying to mitigate against is regulatory risk, and you should anticipate government regulations in these areas, and that's something that's a risk to your business. And they're telling you that on the one hand, and then they go on the other hand with their lobbyists, and guess what? They're lobbying for regulations. So it's a self-fulfilling prophecy. Oh, you better watch out for these risks. Meanwhile, I'm going to pay all these lobbyists to try to make those risks a reality. So there's a lot of just underhanded activity going on at that level. And managers, I think Peter Klein made this point in the Libertarian Scholars Conference when it came to issues like diversity, equity, inclusion. He was giving a lecture on why companies go woke. And he sort of suggested that managers and CEOs don't want to touch controversial stuff. So what they'll do is they sort of just outsource the controversial stuff. Like, you know what, if I just hire a diversity, equity, inclusion officer, I've checked that box, I've saved my head. If they mess up or whatever, it's on them, but I don't really care about this stuff. I have no stake in it, but I'll just do this to make our company look good because this is what everyone else is doing, and that's what corporations like to do, is mirror each other, and then everybody can kind of feel good about what we've done, and it may be just a massive waste of resources and capital, but at least we have covered our image.
I guess what bothers me the most is that they're going to get away with portraying all of this stuff as not political. In other words, you're for DEI and ESG, that just is being a good person. an equitable person, an inclusive person, a fair person, as opposed to being a political person. I consider ESG and DEI highly political. In other words, I consider the idea that the planet is somehow in peril. That's a political statement, and that's a political viewpoint. The idea that America is deeply racist and that needs to be fixed, I think is a political statement and a political viewpoint. And as such, I choose to disagree with those statements, and that's my political outlook. But I know this from academia, and I suspect this is going to spread not only throughout employment more broadly, but maybe even in investing. You're essentially going to be forced to sign what sounds like a Chinese party loyalty oath to apply for a job in academia. We have these PhD young people, and they have to sign off on, this is what I'm bringing to help diversity, equity, inclusion, which is basically a way to subtly and slowly begin to criminalize dissent. We saw this with the March for Life rally a couple weeks ago in Washington, D.C. The left is no longer saying, we're pro-choice, you're pro-life. They're saying you are bigots, and to hold a pro-life position, whether from a religious perspective or not, is to be a bigot who wants to harm women and reduce their rights. So that's no longer about your politics. That's getting awfully close to, we don't hire bigots here at Friendly ESG Company. Being pro-life is a bigoted position, hence we don't hire pro-life people. Well, 25 years ago, he was said, well, that's your perfectly protected political view to be against abortion. I'm not so sure we aren't headed to a point where to be against, some of this climate change BS, to be against some of this DEI BS isn't going to be basically not viewed as a political position anymore, but as just a bad person who is excludable from employment, from investing, from participation in American life.
Yeah, I got a couple things to say about that. I do think you're seeing a trend toward scrutiny among some states, Florida being the most notable example under DeSantis, and examining how much state money is being spent on DEI initiatives at universities. South Carolina is the latest one to sort of audit DEI, so to speak, and see what kind of money is being spent on those things. But the other point I want to make is, we live in a noisy culture with everything politicized. You go to a restaurant and the type of straw you get, whether it's paper or plastic, is making a political statement. Whether you hold the door open for somebody as they walk in is now a political statement. Everything's a political statement. And
get a plastic straw, and yes, hold the door
open. Yeah, that's right. I agree with you on both of those. But that makes it sometimes difficult to sort of step back and remove yourself from the culture and just look philosophically at what's going on and to examine, okay, what does it mean? What does diversity, equity, inclusion mean? What do those terms mean? Mm-hmm. Because diversity sure looks a lot like uniformity of thought. Equity sure looks like it is completely throwing out the old notion of equality, the Martin Luther King notion that we're going to judge people not by the color of their skin, but by the content of their character. Now it looks a lot like we are going to judge people by immutable characteristics, by their skin color, the way they were born into the world, things they didn't choose, rather than on the basis of their actions are things they did choose. And inclusion sure looks a lot like exclusion. We're going to exclude all of these politically disfavored organizations, and you are only included if you buy in to the D part, which is actually the uniformity of thought. As long as you believe what we believe, you're welcome. And I find it interesting that, for example, under these diversity, equity, and inclusion efforts, Christianity becomes very disfavored. It becomes something that must be ostracized, marginalized, pushed out. It can't be included. You'll see student groups at public universities that aren't allowed to have certain speakers or aren't allowed to get funding for their organizations. Well, I don't think I know of any other group on the face of the earth that is more diverse in terms of ethnicity, in terms of wealth, in terms of region than Christianity. Christianity is on every continent in this country. There are rich Christians, there are poor Christians, there are Christians of all walks of life. And so the actual example of diversity that we have, the most diverse group we have on the planet is somehow excluded from diversity under DEI. It makes no sense.
Sure, absolutely. And I think, again, we're getting towards a point where the left is going to say, we're not going to allow you to use religion to excuse your bigotry any longer. And I could certainly see, this has probably actually occurred, someone refusing to hire a rabid Trumper 2 or 3 years ago when Trump was still in office versus, when George W. Bush was first elected. Look, the left hated him. They called him a Nazi. They called him all kinds of things. But we weren't at the point yet where people would say, well, I'm not going to hire anybody who voted for Bush. I think lots of people probably said, I'm going to hire anybody who voted for Trump. So I think, whether this is below the surface or whether this is open, I think this is happening.
Yeah, well, more frightening to me than the hiring, because, people can hire whoever they want to hire if they don't like somebody, whatever they don't have to hire. But to me, it's banking.
Alan, we're not going with private company bro anymore.
No,
we're past that now.
Well, but
they can't hire whoever they want, apparently.
It's the debanking stuff that's frightening, because people will say, well, is debanking really happening in the United States? And you'll say, well, people that were associated with Proud Boys got debanked, or that were associated with the January 6th Capitol riot. They've gotten debanked, and people say, well, we're kind of okay with it. They were unsavory. We can't. Right. Well, why don't you go ask a Canadian trucker what they feel about getting debanked, when the Canadian government can go tell its financial institutions, shut down, freeze these bank accounts, because these people hold views that we don't like. And this is Canada. This is not like some banana republic totalitarian regime. It may be totalitarian in another way, but I tell you, the way things are going, that's what's coming for us. People will say, oh, you think like that, you don't get a loan. You can't bank with us. And either we're going to have parallel economies for people that hold conservative views and economies for people that hold progressive views, or the progressive economy, the ESG, will take over everything and just force everybody into compliance and dominate.
Well, tell us about your work, how people can follow you, and are you willing to go out there and try to be the face of the anti-ESG movement? I mean, that comes with some risk, I would imagine.
I suppose so, but what's the point of living if you can't stand up for principles and fight back against things that are so obviously wrong? But I have a website, which is allenmendenhall.com. You can find me on the Mises Institute website and just start linking around from there.
Okay, well, he's making waves right here in the state of Alabama at Troy University and becoming the face of the anti-ESG movement. So we're going to keep up with this, and we'll be back next week, another episode, joined again by my co-host, Dr. Bob Murphy. Have a great weekend.
Check back next week for a new episode of the Human Action Podcast. And in the meantime, you can find more content like this at Mises.org.